Picture this. You're on an airliner. Maybe you're over a mountain range or somewhere in the middle of the ocean, and suddenly the airplane starts to tumble around a little bit. The seatbelt signs come on, the pilot announces you're heading into turbulence, and you're jostled and bounced around. You're feeling at best uncomfortable, and at worst, maybe a little afraid. Maybe you don't even have to imagine this. Maybe it's happened to you. Now, in a small airplane, as a pilot, what I was taught is when you hit the turbulence, and I've been in some pretty severe turbulence, what you do is you just ride it out. You keep the nose on the horizon, you keep the wings level, and you let the turbulence do whatever it wants to you. In fact, trying to correct for it, making massive movements on the control column could actually damage the aircraft. And investing is the same way. Most investors aren't tripped up by numbers and ideas. They have at least usually a very basic understanding of the stock market and how it works. They're familiar with terms such as reinvesting dividends, compound interest, averages, diversification. But here's the thing, as human beings, we're wired for survival, not for the stock market. Smart people panic because what they do is they mistake action for control. Something's happening. I've got to do something. And it feels like taking money out of the market or timing a move is doing something, but often that's fear talking, not intelligence. I had a friend who had a fair amount of money invested during a very severe downturn in the market. He was even told by his financial advisor, it's going to take years to recover if it ever does. Get everything out of there, which he did, and then he put it into something else. What happened? What always happens. The market turned around, and he missed out on the gains. Not only did he miss out on future gains, but he actually created a loss he didn't have to experience. By selling the stocks, by selling his investments off, he realized a loss. He made it real. Historically, staying invested beats trying to time the market. Missing just the best 10 trading days of a year can have a huge impact on what your portfolio does. You can miss a lot of gains. Over a 90-year history, broad markets such as the S&P 500 or the TSX have averaged gains of about 8 to 9% per year. Yes, there were years when it was negative, but when you average it over the long term, the stock market has always made money. Every time there's a dip, doomsayers pop out of the woodwork saying, this time is different, it's not going to recover. The fact is, it recovered in 1929. It recovered after 1989. It recovered after 2001. It recovered after 2008. And it recovered after COVID. And then not only did it recover, it went on to set all-time highs. And the people who panicked and got out lost out on all of that potential earning. If you're finding these videos helpful, please let me know by giving me a thumbs up and consider subscribing to the channel and tapping that notification bell so you don't miss any upcoming videos. I release videos on finances every Friday morning. Now back to psychology. An interesting discovery that psychologists made is that we experience loss at about twice the rate that we experience good feelings. For example, losing $100 feels twice as bad as gaining $100 feels good. So what should you do instead? Well, for starters, stay invested. Do a little bit of research before you invest. Make sure what you're getting into is a solid investment, not something speculative, and then just hang on to it no matter what happens. Secondly, prepare for the turbulence. Realize that there are going to be days when the market's down. There's going to be days when it's down an awful lot, and there might be market corrections that could last for months or potentially even years. It's part of investing. Avoid timing. People who try to buy low and sell high often end up buying high and selling low. Just stay invested. If you're in retirement, or if the volatility of the stock market really upsets you, then consider investing in something that's a little more stable. You will not get the returns that you would with the market, but if you gain peace of mind for you, it just might be worth it. Consider T bills or government bonds or other investments that are going to simply pay you interest over time. This is the strategy that I follow. No, it has not always been easy. Yes, there have been times when I've watched my investments go down, but it always works long term. There's no guarantee against downturns in the market. They are going to happen, but over years, over decades, it's going to go up. Just as an airplane weathers turbulence with small adjustments, no big control movements, do the same with your investment journey. Stay calm, stay invested, and let time work its magic for you. Thanks for watching. I'll see you next Friday. And in the meantime, here's a few other videos for you to check out.